When the broader market starts to slide, most investors panic. But for short sellers, a falling market is an opportunity, provided you know how to spot the moments when a downward trend is about to accelerate. To capitalize on that momentum, we look for a very specific chart formation called the descending and inverted scallop. In this video, we're going to break down exactly how to trade it. We will cover how to visually identify the valid pattern on a chart, how to filter out common traps that cost traders money, and how to calculate exact entry and exit points for a short trade. By mastering these steps, you build a calculated, mathematical edge. You learn to ride downward momentum safely, locking in positions before the rest of the market catches on. We begin with the visual signature. A valid descending and inverted scallop requires a specific sequence, a preceding downward price trend, followed by a brief bump up that rounds over smoothly, and then a sharp, almost vertical drop. Look at this chart. The pattern forms an inverted bowl at the top, leading into a steep downward leg. Together, these create an upside-down J shape. The height of that rounded bowl should measure roughly half, about 55%, of the massive drop that follows. To confirm that shape, you have to anchor your measurements correctly. Measuring from the wrong price points will invalidate your analysis. This diagram marks 4 potential turning points, A, B, C, and D. Use the inner points, B and C, as the true start and end anchors, discarding outer extremes A and D. Point C must sit at a lower price level than point B. A proportional upside-down J-shape paired with a lower endpoint is the baseline requirement. Without both of these elements, the formation is structurally invalid and you should move on. Traders often lose money here by falling into one specific trap, mistaking a symmetrical U-shape for an inverted J. Here is what that trap looks like on a chart. Notice the curved marking on the right side. Point A and point B are nearly level in price. Because it lacks a significant downward leg, it fails to form the required shape. The pattern must remain proportional. A wide bowl at the top requires a significant drop to follow it. A wide turn paired with a short decline is another sign of a failed setup. Once you have a valid shape, the execution phase begins. But you must never enter a trade based purely on the visual pattern alone. The pattern is only confirmed when the daily price officially closes below the lowest low of the entire formation. You draw a horizontal confirmation line at that bottom threshold and wait for a candle to break and close below it. Conversely, if the price climbs and breaks above the pattern's highest high before it crosses your bottom confirmation line, the setup is dead. Scrap the chart entirely. Patience is mandatory. The formation is just a theory on your screen until that daily close below the low provides the mathematical validation to act. The cardinal rule for the descending and inverted scallop is environmental. It performs best and should primarily be traded during a broader bear market. The data supports this restriction. In bear markets, the average price decline after confirmation is 23%, and the stock reaches its ultimate low in roughly half the time it takes during a bull market. Let's look at the entry mechanics on this chart. You initiate your short position after the price confirms the breakout by closing below point B. Immediately place a tight stop loss just above the pattern's start point or absolute high to protect your capital. To calculate your target exit price, use the measured move technique. Calculate the vertical distance between the formation's highest high and lowest low. Then, subtract that exact dollar amount from your entry breakout price to project your target downward. Before finalizing that target, scan the chart for historical price support levels nearby. Underlying support often triggers pullbacks, which can interrupt downward momentum and damage the trade. By combining a bear market environment with a strict stop loss and a calculated measured move, you transform a visual observation into a highly structured, risk-managed trade. To successfully trade this formation, your system must be rigid. Verify the inverted J-shape, filter out the symmetrical U-traps, wait for the definitive daily close below the low, and always set your stop loss. Your next step is to put this into practice. Open your charting software, filter your view to a known historical bear market, and locate 3 valid inverted scallops on the daily charts. Before risking any real capital, draw your horizontal confirmation lines and calculate your measured move targets on paper. Consistent profit in short selling does not come from guessing where the broader market is headed. It comes from rigorously applying specific mathematical rules to every single setup you trade.